Hello colleagues, my name is Amit Jain and I will discuss with you Standard on Auditing 320, which talks about materiality in planning and performing an audit. To give you an overview of SA 320, I will talk about the scope, what is materiality in context of an audit, then we will talk about some key definitions, and then we will come to the practical aspects of the standard as to how to determine the materiality, what to do with materiality as the audit progresses, and probably how to reassess the materiality. And of course, the documentation. The scope of this standard is very wide, and we need to understand that the concept of materiality is considered throughout the audit. And in particular, when we are assessing the risks of material misstatement, SA 315 deals with the identification and assessment of risks of material misstatements. And also it is considered when determining the nature, timing, and extent of our audit procedures and evaluating the effect of uncorrected misstatements, if any, on the financial statements and informing the opinion in the auditor's report as is laid down in SF 450, evaluation of misstatements identified during an audit. The financial reporting frameworks normally discuss materiality in context of preparation and presentation of financial statements. Misstatements are material in aggregate or individually, which may influence the economic decision of the users. And these judgments are made in light of the surrounding circumstances, which relate to the nature of item or the amount. These judgments on matters material for financial statement users are based on the common financial information needs of all users and not of any particular one user. The determination of materiality is a matter of professional judgment that is affected by the auditor's perception of information needs of the financial statement users. Auditors may assume that users have read these financial statements and have a reasonable knowledge of the business and economic and accounting activities. Auditors may also assume that the financial statements are prepared and audited to certain levels of materiality. In certain jurisdictions, such materiality levels are also disclosed in the main audit report as well. The auditor may also assume that the users understand the inherent uncertainties in accounting estimates, judgments, and consideration of future events, and that users shall make reasonable economic decisions based on the information in these financial statements. Now, where are judgments exercised? These are exercised in the areas of planning and performing the audit, assessing the effect of identified and uncorrected risks of misstatements, and then judgments are need to be made in determining the nature, timing, and extent of these procedures, and also determine the nature and timing and extent of procedures where there are differences or uncorrected misstatements noted in these financial statements. And then in the end, forming an overall audit opinion. Let's look at the objective. The objective of the standard is to apply the concept of materiality appropriately in planning and performing an audit. Let's look at one of the key definitions in determination of materiality, which is the performance materiality. Performance materiality is the materiality level for the purposes of assessing the risks of material misstatements and determining the nature, timing, and extent of these audit procedures. How is performance materiality determined? First, we need to assess the overall materiality for the financial statements as a whole. And this overall materiality is reduced. It is said to reduce the probability that aggregated, uncorrected, and undetected misstatements in the financial statements exceed the materiality at the financial statement level. So typically, the auditor would apply a cut or a haircut on the overall materiality Some auditors apply a haircut of 10%, some apply at 50%. That's depending upon the financial statements that you are auditing and the circumstances of the business. This determines the performance materiality. This materiality is then used to assess the risk of material misstatements and to determine the nature, timing, and extent of the audit procedures. The benchmark is an important aspect to be considered when assessing the overall materiality for the financial statements as a whole, and this requires the use of professional judgment. Generally, a percentage is often applied to this benchmark. Factors that affect identification of benchmark include the user's attention to the financial statements, the life cycle of the entity, the ownership structure of the entity, whether it is significantly financed by equity or debt. Also, the volatility. Profit from continuing operations is generally used for profit-oriented entities. For example, in a profit-oriented entity, the overall materiality may be arrived using a benchmark of profit, and a percentage of 5% might be applied on the profit to determine the materiality. However, in case of a not-for-profit oriented entity, in place of profit, the auditor may apply expense, use expense as a benchmark, and then apply a percentage on that expense. The chosen benchmarks may include prior period financial results, the state of affairs, period-to-date results and state of affairs. In some cases, budgets or forecasts may also be used, but a word of caution that changes in the industry and the economic environment should also be considered. Where the financial statements are prepared for a period of less or more than 12 months, materiality should relate to the whole of that period. Let's take an example. For example, in an owner-driven entities where profit is nominal and the owner takes much of the profit in the form of remuneration, profit before remuneration may be considered as an appropriate benchmark. Materiality for classes of transactions, account balances, or disclosures may be separately determined. Factors that an auditor would need to consider when setting such materiality level would be the laws and regulations or the financial reporting framework which affects the user's expectations regarding the measurement or disclosure of certain items. For example, the managerial remuneration in case of a company. Also, key disclosures with respect to the industry in which the entity operates is also an indicator which would require that an auditor set a materiality for that particular class of transactions. For example, the R&D expense. Focus on particular aspects of entity's business and that is separately disclosed. For example, in case of an acquisition. As the audit progresses, the auditor should consider or assess the need to revise the materiality if he becomes aware of certain other information during the course of the audit that would have caused him to determine a materiality threshold differently. For example, where there is a significant business which has been disposed of. If materiality level requires lowering, the auditor would need to revise the performance materiality and then assess the appropriateness of the nature, timing, and extent of procedures which are required to be performed in addition to the ones which are already being performed. Last but not the least, documentation is an important aspect. While preparing documents, the auditor should include the following aspects in the documentation, which is what is the materiality determined for the financial statement as a whole, the judgments that were exercised in relation to this determination, whether a performance material or a materiality level was assessed for any class of transaction, account balance, or for any disclosures, the performance materiality as well, and towards the end, if there is any revision to the materiality thresholds, what were the revisions and how were the additional procedures performed. With that, we come to an end to this session. Thank you.